So this is my first quarterly investment update on video. So I'm not sure how exciting this is going to be looking at charts and graphs, but let's go ahead and take a look. So this is the end of the third quarter, 2012, ending in September. What we're looking at here, this is a graph showing the Canadian stock market, international stock market, U.S. stocks, real estate, and bonds. Hey, all the arrows are up. That's what we want to see. And of course, we segment the market into stocks issued by large companies, stocks issued by small companies, and growth and value. And we can see that small company stocks have beat large company stocks. And in this case, in Canada, growth is just slightly better than value. And we have got the same for U.S. The only thing that's down are global REITs. Okay, let's look at our next chart. We won't spend a whole lot of time here. Again, what this has done is just broken down the Canadian stock market, U.S., international, real estate, and fixed income. And again, if we look out 20 years, we can see, value stocks have outperformed growth stocks, and small company stocks have outperformed large company stocks. And as you know, we often recommend factor investing, which means tilting your portfolio so there's a little bit more value stocks in it and a bit more small company stocks. The other thing that's interesting on this chart to look at are the Canadian bonds. Going back to January 1980, they've had an average rate of return of about 9.7% per year, which is fantastic for bonds. And as everybody knows that had a mortgage back then, interest rates have been coming down since 1980. And at some point, we're going to see this bond rally turn around the other way when interest rates start to go up. I'm going to skip that chart. Basically, look, all this chart showing is if you were to pick any color, which one would you pick? And it's random. There's no pattern. So that's often we suggest, just get a blend of all of them. Canadian stocks, U.S., international, and you've got a mix of all, just for diversification. I'm going to skip this chart. I'm going to skip this one. This is an interesting chart. Just looks at the 10-year rates of return of different countries. Look at these top countries: Colombia, Peru, Egypt, Brazil, Indonesia, Thailand, Turkey, Chile, Czech Republic, Mexico, India, South Africa, and the Philippines. Look at these rates of return. Around 25% a year, 35% a year. Did really well. Here's Canada down here. U.S. is here. And, of course, these are some familiar names down here: Greece, Ireland, Finland, Italy, Japan. I won't spend a lot of time here. Just looking at bond returns. I know we talked. Bonds have done well. This is the yield curve. You hear about this on the news sometimes. So short-term interest rates have not changed much at all. If we were to purchase a 30-year bond, if we purchased that bond last year, the rate of return on it, layman's terms, would have been about 3.5%. Today, if you bought that same bond, the rate of return is about 2.5%. So the yield curve is coming down. Growth of wealth over 1 year. If we look at that, we've got U.S. stocks, global real estate. They were the best performers, and Treasury bills or cash down here. If we look out over 3 years, again, it was U.S. stock, global real estate were the top performers. In this case, international stocks were the worst performers. If we look out over 5 years, somebody made an equity purchase or stock purchase about 5 years ago, basically haven't made anything. This is the balanced fund, the checkered fund here, and the best performing asset were Canadian bonds. If we go out 10 years, though, we can see the best performing stock markets were Canada and emerging markets up here. If you invested 10 years ago, $1 in the Canadian market, it's now worth $2.55. But what's interesting to note, if we look at our 5-year rate of return, 5 years ago, you wouldn't have made anything in Canada. So all those gains over 10 years came in the first 5 years. And of course, down here, Treasury bills or T-bills, cash, was the worst performing investment over a 10-year period. So there's my first quarterly report. Not sure how exciting that was, but we'll work on it and see if we get a bit more excitement into these as time goes on. Thank you.